Chapter 15, financing two primary and secondary markets. This is the the third chapter of financing of talking about mortgages. So this is the third and final chapter on that, financing two primary and secondary markets. So in this chapter, we're going to describe various financing techniques, identify the sources of real estate financing in the primary mortgage market, and we're going to explain government influences in mortgage lending. So once again, we had this in the last chapter as well, but here I have a slide for us on how lending works in a nutshell. The banks lend their depositors money, even though we technically learned that that's not true. But so the banks would lend their depositors money with the intent of reselling those loans to get their money back, plus interest, plus a servicing fee for collections. Most lenders are not portfolio lenders, the ones that lend their own money. And because those ones generally don't resell their loans. However, most other lenders do. They write loans, they originate them with the intent of reselling them. Portfolio lenders do not. Loans are originated in the primary market to consumers to purchase real estate. And then those loans are resold to investors in what has been called the secondary market. So primary market lenders, some of those sources to borrow money from to purchase real estate, are mortgage bankers, mortgage brokers, and credit unions. Fannie Mae is the largest purchaser of loans in the secondary market, and it's estimated they buy 1 out of every 10 loans that are originated. So they got a lot of pull in their lending decisions for the types of loans that they're willing to buy. So therefore, the banks originate loans according to Fannie Mae's guidelines, because that's one of the largest purchasers of loans in the secondary market. So most local lenders will write their loans, originate their loans. They'll have their lending standards according to those guidelines for the types of loans Fannie Mae is willing to buy. So that's a lot of power. That's a lot of pull. So when Fannie Mae changes their lending guidelines, the local lenders usually change theirs to match. Now, Ginnie Mae, that's Fannie Mae's ugly stepsister. I say that because she purchases those riskier loans. They pay back a higher return, and of course, they charge more interest, but those are like loans that are riskier to people who are maybe not putting as much money down or don't have, let's say, perfect credit. Freddie Mac purchases conventional loans in the secondary market from portfolio lenders. And because those loans were not originated with the intent to resell them, they didn't follow any third parties lending guidelines. So they need to be analyzed on a case by case basis. But anyway, when a portfolio lender needs to liquidate some of their assets and sell their loans, well, who will buy them? Freddie Mac. We get our notes queued up here. Yeah, with me, right?
Yes.
All right. So, like I said, some of the sources of financing in the secondary market are lenders. The lenders loan their money to purchase real estate as an investment. In exchange, they earn interest. Some examples of institutional lenders are savings and loan associations, commercial lenders, insurance companies, those private investors, mortgage brokers. A mortgage broker deals with many different lenders. Credit unions, those nonprofit banks, and pension and trust funds. Let me know when you got those highlights.
And got it.
Right. So I put together this slide to give you an idea of how applying for credit works. All right, so let's see how applying for credit works here. Give me 1 second. So first we start off with the application for credit. We start off by calling a mortgage loan originator or solicitor, the mortgage reps. To get a pre-qualification letter, you just got to tell them your social security number so that they can run your credit. And then you tell them how much money you make, approximately how much money you make, and what your approximate long-term debts are. And based on that unverified information, the only thing verified was they ran your credit report. But as far as your income, your expenses, and your assets, that's all been unverified. And they issue you a pre-qualification letter. Now, once they verify your income and your assets by looking at your bank statements and your tax returns and your pay stubs, then they could have their underwriters review your information and then give you a loan pre-approval letter. That's so a pre-qualification letter versus a pre-approval letter. The only difference is all the information on a pre-approval letter has already been verified now. So which one is better? Which one is more likely to get the loan? In your opinion, which one do you think is better? Hello?
The pre-approval letter?
Yes, definitely the pre-approval letter is better because all the information's been verified. So we should get our clients, the people we work with to show them properties, at the beginning, get a pre-qualification letter before you waste your time taking anybody out showing them houses and setting up appointments. But have them work towards getting that pre-approval letter as soon as possible. And you could educate your clients by telling them, listen, once we find that perfect house that we want to make sure that you give me some ammunition to fight on your behalf. So when we submit an offer, especially if there's multiple offer situation, I could make yours look better by having a pre-approval letter so that I can let that seller know the difference between a pre-qualification letter and a pre-approval letter. We know the person with the pre-approval letter is more likely to get the loan versus an unverified pre-qualification letter, which you don't know if they'll even qualify to get the loan. And it gives us ammunition, especially in multiple offer situations, to negotiate. And through the process of underwriting, someone called an underwriter works for the bank, and their job is to examine the risk to the lender. So they process loan applications by carefully investigating the applicant's financial information and information about the property to determine if they're going to grant the loan. The lender examines all the buyer's information, the approval and borrower process. So the finances, they look at the income, their expenses, their debt to income ratio, their assets and credit history, and then they determine the risk to the lender. Then they examine the property information. So an approval of the property that's being financed entails getting an appraisal. That's an estimate of the value of the property to make sure that it'll serve as proper collateral. They're going to want minimum destroying insect report. So if they can't require a home inspection, but at minimum they could require a wood destroying insect report to make sure the place is not in danger of just falling down because it's been eaten up by bugs. And then certificate of occupancy and fire inspection. If the municipalities require them, they're going to want to see those as well, that the property is up to snuff and good to go. And then the underwriter evaluates all this information to determine whether they're going to grant the loan. And if they decide that they're going to grant the loan, they issue what's known as a loan commitment or a commitment letter. That's where the lender commits to giving the loan to the borrower. So a commitment letter is issued after the borrower completes their loan application. They submit their financial info, which is verified, and the property appraisal and inspection reports. If the underwriter decides they're going to grant the loan, they do issue that commitment letter. So on our sales contracts, we actually put a date there when the buyer needs to produce the commitment letter by. So the lender is committing to grant the loan. That creates the contract with the borrower as far as the issuance of credit goes. Okay, anybody want to snap a picture of that? See how all that works? All right. So let's do this highlighting. Yeah, this is what the book has to say. Whose notes are a little more thorough.
I'm done.
Okay, got him? All right, so now how do the credit scores work? Well, FICO credit scores, that's your Fair Isaacs Company credits rating system. It's a statistical method to determine credit worthiness. Scores below 620 are considered subprime and riskier to lend to. Scores are usually used by credit bureau. Scores are used by credit bureaus. They don't average them out. Your score is the one in the middle. So they usually run the credit with the three major credit reporting agencies, and then whichever one is in the middle, that's your credit. That's your credit score. They don't average them out. Okay, that's not how it works. So pretty simple to figure these ones out.
I have a question though, because I remember helping my dad finance a new truck for the company. Um, Most companies are like, or most dealers are like, we only use Experian or we only use Equifax, or but do they actually look at three without even telling us? Or
Well, usually when they're buying a car, they do. No, but they should tell you. When we say they're going to run the credit report, okay, but they do run it with all three major credit reporting agencies. And that's usually a hard hit on your credit. It's a hard inquiry, what they call. So it does show up on your credit report, and it if you have many of those, what they call hard hits or hard queries in your credit report, it could slightly affect your credit score. Um, a couple points, temporarily, because there's a lot of sudden activity on your account. So they don't average the scores. Your score is the number in the middle. You take the high, they take the low, and yours is the one in the middle. That's your credit score.
I I
Yeah,
have a question.
yeah.
What does like a credit score consist of? Like what determines your score and your number?
Isaac's credit reporting system. It's that statistical method that they invented. But what makes up your credit score? Are you
Yeah.
saying that maybe so that you could have a better understanding? Okay, sure. Length of your credit history, how many lines of credit you have, the amount of credit, usable credit that you have available to use, how much, the percentage of credit that you're actually using that you have available to you, um, your payment history, your repayment history of your debts, late payments and things of that nature. Let me see, paying back your debts in full. I found that if you, what I do is I charge everything, and then I pay it in full at the end of the month. I
Mhm.
don't do stuff if I don't have the money for it. Okay, when you do that, now you're carrying balances, and when you carry over balances, depending on how much the balances are and everything, it could affect your credit. You know, you should keep your credit usage below. I forget what the exact amount is. It's like in the high 20s, low 30s.
It's below 30%, I believe.
Yeah, something like that. That you should keep your usage below. Let me see. If you guys sign up for that Credit Karma website, it gives you a lot of useful information. Once again, I'm going to try it. My login here, which I forgot my password. Do it. Let me see if I can log into this thing. It gives a lot of useful information, and how to improve your credit, and it updates you. It updates you on your credit usage, if there's been any charges or requests for new credit or things of that nature. Uh, and it's a good way for you to keep up, make sure that there's no identity theft going on and things of that nature. It's a pretty good thing. It's free, and it doesn't affect your credit at all. And you could check it as often as you want. I think they only update it and run the credit once a month, but it does not. They're not hard queries. I'm just covering my login here a different way so that I can log in here and see. Gosh. So much information for forgetting your password. Okay, here we go. All right, whatever. Okay, so it's telling me my last 4 digits of my social security are on. Sure. Oh, no, that's not it. Okay. Anyway, yeah, so there's a lot of different factors like that that affect your credit. When you get to credit repair, these credit repair companies and such, uh, they often charge a fee just to give you the same advice that I just gave you.
Thank you.
All right. I'm on one last step here trying to recover my login. Second here. Right, Farmer, where are you? Oh, wrong email. There we go. Don't get the code. Hey, I recovered my login. There we go. Take a while. All right. So yeah, getting Credit Karma, it's free. It's a good way to monitor your credit. It doesn't give you the exact credit score. That credit score, I don't know if it's the exact credit score that's giving you there, but it's a good way to keep up on it and monitoring it. Yeah. Here. I'll show you an example of my credit score. Not too shabby, eh? Considering they only go up to 850, I got 825 and 824.
Congrats.
Yeah.
That's nice.
Yeah, I just had some crap credit score at some point in time, you know, made a bad investment, got myself in debt, you know. But you know, you keep track, it shows you all of your credits. You know, I mean, do a lot of sales pitches here offering you different credit cards and other nonsense like that. But at a glance, I could see, you know, if I have like when I had outstanding amounts for financing on my car and my motorcycle, you know, it showed me that. But now it knows what my car and motorcycle is, so now it's like always giving me offers on insurance and stuff like that. I guess that's how they make some of their money, by trying to sell people on credit cards and things of that nature. But let me see. Okay, look at this. So it's showing me what my tax refund is predicted. All right. Anyway, it's a pretty neat tool. I suggest you guys get it. Keep one of those in your finance books, in your finance records there, one of those types of apps. Okay, so but your credit plays a major role, but it doesn't play the only role in determining risk to the lender. So qualifying ratios are another part of it. An example of qualifying ratio is a DTI, debt to income ratio. These are used to determine the maximum monthly expense for housing that a borrower could afford to pay. PITI. An example of a qualifying ratio would be 2836. So 28 would be the monthly income for housing expense, and 36 would calculate the income and all long-term debts. Excuse me. Sometimes up to 48% is permitted, depending on the lender, but the average there's 2836, but that I've seen much higher, like 48. But you really shouldn't be using it, overextending yourself like that. Now, the New Jersey Department of Banking and Insurance created that home buyer's guide I already shared with you guys the other day. Here's the link to it again, right from their website. And where you guys, oh yeah, here. Let me give you that link. You guys can share that. But here, let me click on it. Take to it. And they talk about types of loans and things that we've already gone over, loan affordability, all that stuff. But where is it? They talk about debt to income ratio. Oh, what we're talking about right now. And they have that information, look, about the credit reporting. You can get your free credit report annually from all free credit reporting agencies. It just doesn't include the score from annualcreditreport.com. Or you can sign up with each individual credit reporting agency. And make sure you write down your login information and all the information that you give in for security and stuff, because if you're off a slightest thing on one thing, you're not going to get your login to get into there. They try to really protect your credit and your access to it. Okay, so here, PMI, private mortgage insurance, all that stuff we went over the other day here. The qualifying ratios they're talking about right now, determining the loan affordability, okay? I actually have screenshots of this coming up on the next slide, but this is the book. This is the booklet that I got it from. This is the New Jersey Real Estate Commission. Actually, the Department of Banking and Insurance created this, the Home Buyer's Guide. So I'll share that link with you. Just take care of these notes right now and do these highlights. Qualifying ratios, and then right next to this, right small enough to fit it. An example of a qualifying ratio is a DTI, debt to income ratio, used to determine the maximum monthly expense for housing a borrower could afford to pay. PITI, isn't PITI your total maximum monthly expense for housing? What does PITI stand for? Principal.
Interest.
Spit it out. I'm saying it. Yeah. Taxes
and then
and homeowners insurance. Yeah. So
insurance.
principal and interest, that's your loan, plus property taxes and homeowners insurance. That's what PITI stands for. And so write down those notes. Let me know when you guys have it. And I'll share with you in the chat window once again this guide.
I'm good.
Hey, anybody still writing that? An example of a qualifying ratio is a DTI, debt to income ratio, used to determine the maximum monthly expense for housing a borrower can afford to pay. Everybody good there? Anybody still writing?
I'm good.
Okay. So here's that excerpt from that booklet from the Department of Banking and Insurance. They say debt to income ratio is one of the first factors a lender may consider when deciding how much of a mortgage loan you qualify for. Well, first they need to determine how much you could afford to pay monthly. And then based on how much you could afford to pay monthly, they could determine how much they could lend you. Okay, so they kind of work backwards into it. So the debt to income ratio, or DTI, to calculate your DTI, you add up your current monthly debt, your credit card payments, car loans, etc., all those long-term debts, and you divide it by your total monthly pre-tax gross income. This percentage ratio is a simple way of showing how much of your income is available to make a mortgage loan payment after all other continuing debt obligations are met. They mean your long-term debt obligations. Lenders often call this the 28-36 qualifying ratio, although some lenders may have a slightly different ratio. The first number, 28%, indicates the maximum amount of your monthly pre-tax gross income that the lender allows for monthly housing expense. This amount will include the principal and interest of the loan, property taxes, and homeowners insurance. Pity. The second number, 36, represents or refers to the maximum percentage of your monthly pre-tax gross income that the lender allows for monthly housing expenses, plus all recurring debt, like your credit cards, car payments, etc. So if your ratio numbers are higher than 28-36, you may want to consider reducing your debt by paying off some credit cards or other loans before you start your home search. When calculating and relying on your DTI to determine loan affordability, be confident with your numbers and don't be afraid to stick with them as you shop around. Some lenders may allow higher ratios and be willing to loan you amounts that will take you beyond the traditional qualifying ratio and what you can afford. This could lead to more costly monthly payments and might cause a financial hardship to you because you're kind of stretching, using all your money to pay bills every month, so you don't have that much leeway for savings and such. That's why they say you should probably stick to your numbers there. All right, so let me see. So this could lead to more costly monthly payments and might cause financial hardship if you find that your loan is not affordable once you move into your new home. All right. Now, we spoke about government influence in mortgage lending before. We learned about the Fed, the Federal Reserve, that it's not actually a part of the federal government, that the Federal Reserve is just a name for what we call the central bank, the central banking system here in the United States. That central bank is called the Fed, or the Federal Reserve. And their job is to try to counter inflationary and deflationary trends. Basically, in other words, their job is to see how much maximum interest rate they could charge and still not destroy our economy. Okay, because that's their job as bankers. Their self-interest is to make themselves money, right? So what's the highest interest rate they could charge in an economy? Now, if an economy is booming, what do you think's going to happen to interest rates? If an economy is doing well, if it's booming, what happens to interest rates?
They rise? Oh, no.
They rise. That's correct. They rise. Why? Because people can afford them. That's why when we have a crappy economy, the interest rates fall to like all-time lows, right? But we've had some serious problems with our economy and stumbling, and you often hear the president trying to negotiate with the head of the Federal Reserve to have him keep the rates lower, even though our economy is doing well, so that our economy can do even better and give us a chance to get us really, really strong footing before they raise the rates. So often you have President Trump in office, and you see him on TV just the other day. I mean, he's always on TV. He's always talking about the Fed trying to get them to lower the rate. They refuse to. They keep raising it because the economy's doing better under him. And he's like, stop. He's like, you're going to raise it too quick, and it's going to cause it to backfire, and the economy could get negatively affected. So The Federal Reserve, their job is to try to counter inflationary and deflationary trends to establish economic stability and maintain sound credit conditions by altering the AFR. That's what we call the applicable federal rate, which all lending is based on. Remember, all the member banks of the Federal Reserve have to use that as the baseline, and then they can mark it up when they're lending based on how much money they want to make off of lending. So if the applicable federal rate's at 2% and they want to make 4%, they could mark it up at another 2%, and then the interest rate that the public sees is 4%. That's the going rate for them, right? Because that's the markup. But there is a cost of lending to the federal to the banks, and they have to go based on what all of the banking members use as a baseline. If they want to be a member of the Federal Reserve, to be able to have that Federal Reserve come to their rescue if needed, they need to be following their rules to begin with. So all those member banks that are a member of the Federal Reserve have to follow their rules if they want the Federal Reserve to be able to come to their rescue if ever needed. Okay. So, I'm going to minimize these fonts a little bit here, and I'm going to try to, let's adjust the messaging just a little bit on this slide.
I actually finished watching the Money is Dead.
Yeah, Money Has Debt. Yeah.
Yeah, I finished watching it last night. Pretty interesting.
Isn't it? It's pretty good. It's a pretty good video.
Yeah, towards the end, I was like, so how can I make bank? How can I create a bank? Like if they're making money out of thin air.
That's a little bit beyond my scope there, but you need to follow whatever banking rules the government has, and then check with the Federal Reserve what are the requirements for their banking. But the thing is, during the Obama administration, you were seeing a lot of small local community banks disappearing because he put in so many restrictions and regulations. He doesn't want there to be any mom and pop banks. He only wants there to be major corporations, these huge places. I know, even though they're always pointing, it's the Republicans, they want those major corporations they're in bed with. Well, he pretty much destroyed small banks. It is next to impossible for there to be any small banks around anymore. And that's why you're seeing them all but disappearing. They're very, very rare to find. And the ones that are around, they probably just got eaten up and became a member or merged with some larger ones. Because he put so much government regulations in place. It's so ironic because they were the very ones that were forcing the banks not to follow their own regulations because they would be considered discriminating and giving loans if they're not giving loans to poor people and minorities. Remember, that's the thing that Barney Frank, the regulator, did. Then they turn around, they make so many rules that in order for the banks to follow them, they need a team of attorneys to deal with all of the paperwork for the regulations and the reporting back to the federal government. And so this is beyond the scope of most small banks. They can't afford it. So he pretty much killed small banking with all of those additional requirements. So that's why you don't see too many small banks around anymore. I know it sounds pretty sweet, right? Hey, yeah, I may want to open up a small bank. Pretty good venture, right? Yeah, it is. It is. If the government didn't step in and put all these over-regulation, regulatory and reporting requirements in place, you probably would be able to. But you need to have a full-time staff of attorneys just to try to make heads and tails with and deal with the regulations and the reporting that was put in place now. So that makes it, hey, who knows? Maybe AI can be used to try to go over your records and help out with that and make that less of an issue now. Maybe, but you got to still be in compliance. So if AI screws up, but yeah, they can't. Small lenders can't afford all of that additional expense. So that's why a lot of them went out of business, or they sold or merged with the larger banks. That's why you're not seeing them around as much anymore. And that was as of President Obama's presidency. You see, prior to that, small banks were thriving. They were popping up all over. Now they're very unicorn.
Yeah, wild.
Yeah. I mean, how many small banks do you see around these days? Do you know of any small banks that are still in business?
Mm,
Oh,
Not that I know of.
yeah, it's hard.
Yeah,
Yeah,
yeah, pretty hard. Yeah.
yeah, that's why. And that's why. Okay, let me shrink down this text a little bit so I can fit a little more in here. I just wanted to write in there about try to counter inflationary and deflationary trends to establish economic stability. In sound by altering the AFR applicable federal rate, which all lending is based on. Bank. And their job is to raise the rates as much as possible for their member banks while trying not to destroy the economy in the process. It is a delicate balancing. There we go. I like that definition. That gives a little bit more insight to other than just using those they try to counter inflationary and deflationary trends to establish economic stability and maintain sound credit conditions by altering the AFR, the applicable federal rate, which lending is based on. The Fed is the central bank, and their job is to raise the rates as much as possible for their member banks while trying not to destroy the economy in the process. It's a delicate balancing. Okay. So the Fed is a central bank, and their job is to raise the rates as much as possible. I'm missing something from that. That could be tweaked a little bit more. I'm just not going to work on it right now. Get my notes in there. Down and down. Okay, so government influence in the secondary market. The government does have a lot of influence. Let me see. We have Fannie Mae. They used to be called the Federal National Mortgage Association. They operate under a shareholder-owned company under congressional charter. What's the definition they give now on page 288 in this version of the book? Because this has changed quite a bit. Several versions ago of this book, it was a privately owned corporation, run by their board of directors. And as all these government bailouts occurred, we, the government, pretty much became the owner of these Fannie Mae, and these operations because we dumped so much money into them until they pay it back. So now they say it's operated under a shareholder-owned company under congressional charter. Yeah, Congress, congressional charter, Congress is managing them. And we're not in the business of running banks or investment groups like this. That's not the country's job. But with all the bailouts, we unfortunately became the owner of these things. So we had to try to change the rules a little bit, try to shore them up a bit, so that then they could be enticing that investors can buy it back, and it could no longer be run by the government here, even though the government has some influence over how these places operate and run. So, well, so let's see. Fannie Mae is the largest purchaser of loans in the secondary market. Oh, wait, I was looking at the definition then. Fannie Mae, let's see. Where's the definition of Fannie Mae? A shareholder-owned company operating under congressional charter. And that's how they still have it listed. So, why is my wording a little bit different here? I'm just going to change this around. Shareholder-owned company. Operating under a congressional charter. Okay, so they're the largest purchaser of loans in the secondary market. They buy one of every 10 loans in existence. That makes them pretty influential. When they change the criteria for the loans they're willing to purchase, often your local lending institutions, they change their lending criteria to match theirs. Why? Because your local banks write loans, they originate loans with the intent of reselling them to investors to get the money back and then re-lend and write new loans again and repeat the cycle. So when Fannie Mae changes their criteria for the loans they're willing to buy, those local lenders, they change theirs to match because they know that Fannie Mae will most likely buy them. And because Fannie Mae is the largest purchaser, they buy one out of every 10 loans in existence. A lot of other of those investors will also be willing to buy those loans that meet Fannie Mae's criteria. So a conforming loan is a loan that meets Fannie Mae's lending guidelines. It conforms to Fannie Mae's lending guidelines. So for the loans that they're willing to purchase, don't confuse a conforming loan with a conventional loan, which you get from portfolio lenders who do not resell them. They keep them within their own investment portfolios. So what is a conforming loan? Come on, guys. It's a loan that conforms to or a loan that meets Fannie Mae's lending guidelines. Conventional loans do not. Well, they could, but they don't have to, because you get them from portfolio lenders who are more flexible in their lending practices. Now, Ginnie Mae, that's Fannie's ugly stepsister because she buys those riskier loans. They pay back higher returns, so the juice is worth the squeeze for them, I guess. With greater risk comes greater reward, right? And Freddie Mac, Ginnie Mae used to be called their stock symbol is GNMA. They were formerly called the Government National Mortgage Association. Freddie Mac, you're not going to be able to sound out their stock symbol like you could for Fannie Mae. Fannie Mae is FNMA because they were formerly called the Federal National Mortgage Association. And if you were to sound it out, FNMA. And Ginnie Mae, GNMA, Ginnie Mae. And then you have Freddie Mac, FHLMC, the Federal Home Loan Mortgage Corporation, and they purchase loans from portfolio lenders. All right. Let me get that reworded definition, and I'm going to put that in the notes. Okay, so let's do our highlights here. Loans that meet Fannie Mae's guidelines are called conforming loans. And, well, Ginnie Mae, just understand that she's related to Fannie Mae, but not Sallie Mae. You know, Sally Mae was the one that gives student loans. So if they give Sally Mae as a answer option, sometimes on state exam, they got a stupid question. It says something like, which one of these loans are related or are not related, you know? And it's like Fannie Mae, Ginnie Mae, Sally Mae. Yeah, Sally Mae ain't A. So remember, Ginny, that's Fanny's ugly stepsister. They're related. Let me know when you got it.
Got it.
Okay. So then we have conforming law, non-conforming laws. If a conforming law is what meets Fannie Mae's lending practices, lending guidelines, what do you suppose a non-conforming loan does? Or doesn't?
It's one that does not meet Fannie Mae's lending guidelines.
There you go. Boom. It's not rocket science, right? So the conforming loan is one that meets Fannie Mae's lending guidelines. So therefore, a non-conforming loan is one that does not conform to or meet Fannie Mae's lending guidelines. Okay. Does not meet Fannie Mae's lending guidelines. These are loans that Fannie Mae is not willing to buy. Those they would buy are called conforming loans, which conform to their lending practices, their lending guidelines. So who do we get loans from that are not conforming to Fannie Mae's lending guidelines? Portfolio loans. Or portfolio, sometimes you call them conventional lenders or portfolio lenders. You get conventional or portfolio loans from them. Yeah, I know those terms, conventional and portfolio, they use them interchangeably pretty much. So conventional lenders are more flexible in their lending guidelines because they're lending their own money without the intent of reselling the loans. So they don't need to meet any third parties' lending guidelines. They could be more flexible. Borrowers with unusual credit situations, not bad credit or buying unique houses or large construction projects. Each project needs to be evaluated on a case-by-case basis on its own merit. So these are used to purchase properties that are non-conforming. A jumbo loan is a non-conforming loan. It is a loan that is larger than Fannie Mae is willing to buy. They're larger than Fannie Mae's lending guidelines. They could be used to buy loans to buy expensive homes that are over the amount that Fannie Mae is willing to purchase. You get them from portfolio lenders or conventional lenders. Okay. So you don't take people to a portfolio lender because you got a client who's got poor credit and they can't get a loan elsewhere. That's not what portfolio lenders do. Would you risk lending your own money to somebody who's got poor credit, unless showing that they're less likely to pay you back? They have a poor history of paying back their loans. Would you?
No.
No. So neither would they. So you take people there with that they don't conform to, they got people who want to buy properties that don't conform to Fannie Mae's lending guidelines. Here, I'll give you an example. I had a friend, he wanted to purchase a 2-family house. It was a cheap 2-family house too. It was $200,000 for a 2-family house. The rents would pay the mortgage itself, but he couldn't get a loan to get this 2-family house. Why is that? Well, he already owns 15 properties, and a lot of lending guidelines are in place that say that, hey, if you own more than 3 or 5 homes, then you don't qualify for these loans. And then his debt to income ratio was off too. Now, mind you, his credit score was excellent. I believe it was 840. Remember, it only goes up to 850. His credit score was 840. He owned a bar. He owned 14 other properties, never laid on a mortgage payment. Most of those properties are income generating properties. But yet I couldn't get the guy a $200,000 loan, a loan to buy a $200,000 house. They said his debt to income ratio is off. So I took him to a portfolio lender, and they evaluated his situation. Sometimes we call this real world decision making. They looked at the situation. They're like, oh, we see what's going on here. We looked at his finances, and on his tax returns, he has a lot of write-offs. And it looks like he's spending all the money that he's making if you were to look at all the write-offs. But we see he's got a bar, it's a cash business. He's probably not reporting everything. He's got all of these properties. Some of them are most of them are income producing properties. Never laid on a mortgage payment. He just got a lot of write-offs. So yeah, we don't see this guy as a big risk to lend to. He's a businessman and he's doing what they do. They try to pay as little taxes as they can, having a lot of write-offs. Like you guys now are going to become independent contractors as self-employed real estate salespeople. Even though you have to be, you're going to be working under a licensed broker, for all intent and purposes, you're going to be independent contractors. So you're going to be responsible for paying your own income taxes at the end of the year. Your brokers are going to pay you the gross pay from your commissions. You need to keep some money aside to pay for some of those, pay your taxes at the end of the year and things of that nature, right? And the way that you can lower your tax obligation is to account for all the money you put back into your business. Keep track of your expenses, like the fee that you paid to take this class. Any state exam fees, fingerprinting, the licensing fee itself, any marketing or advertising, printing of business cards, all that stuff, memberships in the MLSs, your E&O insurance. Keep track of all your expenses so that you can write them off to reduce your taxable income. So let's just say that you make $50,000 in gross income the first year, but you've got $6,000 in expenses. You could keep all the receipts and you could write off those $6,000. So now you only have $34,000 in taxable income. And so now you calculate your taxes based on the 44,000 instead of the full 50,000, right? So this is what they do. Any business person does this. You got to keep track of your expenses so that you could lower your taxable income. So that's what he was doing. My friend was so cheap. Go ahead, say, how cheap was he, Vic? Come on. How cheap was he? Come on. What do you want to know? This guy who was trying to buy this two-family house for $200,000. He had so many write-offs he couldn't get it because he's so cheap. How cheap is he? Well, he's so cheap that when he goes to Home Depot and he sees a receipt floating on the ground, he picks it up so that he can write it off on his taxes. Now, are you supposed to do that? No, because that's not one of your expenses. You didn't spend the money. But now he's got proof, he's got a receipt, he could use it as a write-off on his taxes to reduce his taxable income. All right, don't do that. You're not supposed to do that. That's not very honest, okay? So I'm not trying to tell anybody to do anything that's dishonest, okay? But some cheap people do stuff like that, all right? And he did. By the way, did anybody get a chance to go to our Facebook page and watch that video I posted up there about why 87% of real estate agents fail in the business? Did you guys watch that yet?
No, but I think you kind of said that the reason why most agents fail is because they don't do a lot of listings. They don't do listings.
Well, if you don't list, you won't last. That's just my saying. Otherwise, you're going to be running around like a chicken with his head cut off, trying to constantly work with buyers, showing them homes. Okay, that's the only thing there. With that, you could make more money and you could have list time without sweating it so much if you are working with more listings. So you should concentrate more on listings than dealing with buyers. But, hey, people make livings just dealing with the buyers as well. Here, I'm going to go to Facebook for a second here. Hold on, facebook.com. And we go to facebook.com/Career Path Academy. Here, I'll share that link with you guys. Go there, like it, love it. That's our Facebook page. I do give free giveaways, and I do have a couple of Amazon Fire TV sticks to give away. I give away all kinds of stuff. Yeah, I'm bribing you to like us. So what? Okay. So this is our Facebook page. Okay. So when you go there, you click on that button, you like us, we will include you in on there. So here's that link. Why 87% of agents fail in the business. Well, come on. Stop. What is this? Facebook's doing these things that you got to do inquiries or something to watch a damn video? Come on. What is going on here? I posted a video. Well, you see if any of you can click on it and actually get to the video or not. I don't know why it's not coming up for me right now. Instead, Facebook's got this thing that's coming, a chat window's coming up. Just want to watch the darn video. Come on, Facebook. You're screwing me up here. I'm logged in as me. That's weird. Okay. Oh, well. I thought I was going to be able to show that video there. I do have the link somewhere, but I'm not going to go hunting around for it now. Let me just log into my Facebook page as Career Path Academy instead of myself and see if that makes a difference.
It's letting me watch it, so.
It's letting you watch it? Good. I don't know what the heck is going on here on Facebook. All right, let me see. I'm logging in as Career Path Academy now and see. Can you copy the link and share it in the chat window with everybody?
Okay.
You able to get the share link?
Yeah, give me 1 second. I'm just trying to log in the computer because I was on my phone.
Oh, okay. All right, so let me go back to while you do that, I'll go back to the lesson here in the meantime, because we can watch that at any point. So those are non-conforming loans. And here are the highlights for non-conforming, for Fannie Mae, non-conforming portfolio, what a jumbo loan is. You need to know jumbo loan. You can add that term to your definition sheet there for exams. Jumbo loan, what is a jumbo loan? It is one that is jumbo in size. It's larger than those that meet Fannie Mae's lending guidelines for those that they're willing to purchase.
Okay, got it.
Okay, but he's got that. Right.
I got it as well.
Yeah, got it.
So get this now. We'll just do these highlights, and then on the next slide, I'll have my version of the notes for these things. So let's just do these highlights for right now and take these notes. We're going to learn about financing techniques, all different types of lending. Well, we're going to learn about all kinds of different loan programs.
Okay, I'm good.
Okay.
Yeah, got it.
So purchase money mortgage. If you read it backwards, it's mortgage money to purchase, and that is any loan that is used to buy real estate. Any loan that includes seller financing is also a purchase money mortgage because it's any loan that's used to purchase real estate. Purchase money mortgage, mortgage money to purchase when you read it backwards, right? Tells you exactly what it is, does in the name. Reverse mortgages, well, this is they call them reverse mortgages for a reason. Because under your typical lending loan program, you get a loan from a lender and then you make periodic monthly payments to the lender to pay down the loan. With a reverse mortgage, you have equity built into your home. The lender pays you money the lender pays you monthly. They pay you the equity, making monthly payments to the homeowner, building up debt instead of paying it down. So it's the reverse is normal. This is a way that seniors who maybe don't have a big nest egg that's saved up for their retirement, they don't have any kind of like government pension program or something like that. This is a way they can live out their senior years in dignity and not be trying to scrape by or having to work their entire lives. They could tap into the equity that they built up their entire lives when they were paying off their home. It requires that they have a lot of equity, though. At minimum, 60 to 70% of their home needs to be paid off. Then the lender will step in, pay off the balance so that they are the only lender. They're the first loan, they're the only lender on the property. And then they make monthly mortgage payments of the equity to the homeowner, building up debt. The senior does not have to pay this loan back unless they sell it or die. So when the senior dies or sells the home, the lender's paid back any money that they paid off on your existing loan, plus any payments they made out of equity to the senior, plus the interest that they were charging. And that's how the lender gets paid back. So if a senior dies and like their heirs won't inherit that house, well, they would have to pay back the mortgage company any balance that's owed to them. I don't know why people get this chip on their shoulder that reverse mortgages are bad. Oh, they could take your house, they could do this. Well, any lender can take your house if you don't pay them back, right? It's just a different type of loan program. So it allows seniors 62, okay, reverse mortgages, tapping the equity built into their home. Period. The lender will pay off any existing mortgage loan and then make monthly equity payments to the homeowner. Okay, so that gives a little more clarity into what the reverse mortgage is actually doing there. Yeah, I like that definition. That's good. Okay, so anybody have any questions about any of this? So everybody understand how this works?
Yeah, so what happened? Like
Right.
it's saying that,
I'm sorry.
so here it's saying the senior does not pay back the loan until they sell the home, pass away or dies.
or die.
So yeah, so this is a lender is taking risk. That just take example, like for my home,
The
I
lender
took a
takes risk. Hold on, the lender always takes risk. It's that's why they call it risk-based lending.
okay, okay,
The only
Okay.
difference is instead of you making payments to the lender, the homeowner has the house either already paid off or mostly paid off, and the lender's making payments back to the homeowner, building up debt. So they're paying the homeowner the equity that they already have built into the house. So it's actually a lot less risk to the lender because they already have the house paid off or mostly paid off with a lot of equity in it. So if they should default, stop making payments or whatever, or actually they don't have to make payments until they die, but if they die and the loan is not paid back, the lender could foreclose, sell the property, then use the proceeds to pay off what is owed to them. And then whatever errors they have, they could get the balance of whatever equity was left in there.
so whatever left, what happened that money? That will
Yeah.
go to the lender or
It goes to the heirs.
okay to heirs. Okay, okay.
Yeah.
But the heir is not responsible for paying the remaining balance. If just take example, I take a 1 million loan, and then I died, and the still remaining balance is 800K. But when I sell the house is sold on 600K. So who gonna pay that 200K? Lender gonna take a risk of that 200K, or the heir gonna pay that 200K?
Hold on a second. Forget about the numbers. I don't want anybody getting lost in numbers here.
Mhm.
If the homeowner died that had a
Mhm.
mortgage,
Mhm.
left the house to their kids,
Mhm.
you're going to have to pay back the mortgage company the money that's owed to them.
Mhm.
So they could get their own loan. They could take out their own loan to pay off that mortgage, the reverse mortgage.
Okay.
Or
So
pay the cash. You know, why do seniors get reverse mortgages?
is my understanding that the lender is taking risk that they're gonna earn more. If the senior gonna die, they can sell the property and
That's not the question. The question is, why does the homeowner, the senior citizen, get a reverse mortgage?
to utilize their property.
For
So
don't get complicated. It's simple. I want a simple, stupid explanation. Keep it simple, stupid. Remember that the KISS concept? I want you to give me a simple, stupid explanation that a toddler could understand.
yeah, so my
So they
understanding
can
is
stay
that
with the house longer.
Well, they're not in danger of losing that.
no, they enjoy the money. Whatever the equity of the home is, they want to enjoy the equity when in his presence.
So that they can live out their senior years, their remaining years in dignity, if they don't have a big savings account that they saved up for their retirement and didn't have a retirement plan, like most people don't have retirement plans like government employees do, where they still get a major portion of their salary paid to them, on a regular basis. Most people don't get that. That's special. We hear about this every couple of years, teachers yelling about their retirement plans, and they want the full pay for their retirement and all this, or they want more money for that. It's like, what job pays you your salary when you no longer work? There are no jobs like that. That's only government jobs. When you work
Yeah.
for government, police, fire, teachers, because politicians got no problem giving you other people's money, the taxpayers. Okay?
Mhm.
How come those people don't have to pay into their own retirement? They should, and as a matter of fact, they're going to be. Because you're getting some politicians that are getting involved in there saying that they should pay into their own just like everybody else. It should not be a burden on all the other taxpayers, you know. Hey, listen, great job for teachers that do good jobs. We should be able to fire the ones that don't, though. I don't believe in that tenure crap. Neither did my ex-wife, who was a teacher and then later on a principal. She says, you don't understand this. It's ridiculous. It's a foreign concept. And actually, she came from a foreign country, and she said it doesn't even make sense to her. Why would they give that kind of a benefit to a teacher when they no longer work? You don't get paid if you don't work. You should save money, do investments during your life like everybody else. I'm not picking on teachers. I'm just saying this is a benefit that most people don't get. So most seniors don't have benefits like that. So how do they get senior years in dignity? Well, they're living in it. This is why in the 1980s, Ronald Reagan passed this and made this a law that allowed lenders to offer reverse mortgages. Because back then, I don't know if any of you were that old to remember, but there used to be, I remember because I was a child back then, and I remember seeing on the news some heartbreaking things, and I was a child and I thought it was sad. Where the news reporters, they were interviewing like older people and saying, well, how are you living? How are you getting by? How are you living? Social Security doesn't pay much. Back then, Social Security did not pay anywhere near what it pays today. That's people are wondering why Social Security is going bankrupt. Well, back then, Social Security didn't pay anything near what it pays today. So it was only a couple $100, if that, a month. And they didn't have all these discount drug programs or all that. So the senior had to have the money for this. So you either buy your food or the important medicine that you need to live. What kind of balancing act is that? What kind of choice is that to make? So the reporters were asking them about it. And they're like, well, we need our medicine, otherwise we could die. So, and then they're sitting petting the cat, and then they show them opening the cat food and feeding the cat, and they say, well, we buy this in bulk, the cat food because it's cheap, but if it's nutritious enough for the cat to survive on, oh my God, can you imagine seniors resorting to eating pet food to survive? That was so heart-wrenching. So I guess at the time was President Reagan. He saw that too, and people always looked at the president for answers. I mean, what are we going to do? Come up with another government program to give money? That's what Social Security is, right? So they said, you know what? A lot of seniors, they're living in a house that they already own. They already paid it off, or mostly paid it off. Why not allow them to tap into the equity that they're living in? And they don't need to pay it back until they die or sell the home. So that was a great idea. And that's what actually where the reverse mortgages came about. And since then, we don't got to worry about seniors eating cat food. There's all kinds of SNAP programs and things of that nature for low-income people to be able to get food to survive. We got these Meals on Wheels programs to feed seniors. We have these discount drug programs because back then there was a talk show host, Montel Williams. You may remember him. He was a talk show host. He was a Marine that became a talk show host. He was very popular. He was actually in recent media when Kamala Harris was running for president because he was one of the girls that he had around his arms when he was a player, and had she was all wearing her mini skirt and all that, and trying to get with him. Then there was. He negotiated, he was a big advocate between the drug companies and the seniors, saying, why do seniors and poor people be able to get their drugs that they need to survive according to their budgets, what they're able to pay? And if they're under a certain income, they should be able to get it for free for their drug companies. or at a lower price. And he negotiated that. And now today, you see all these companies out there now. There's all these cards that are sent to you in the mail that you don't even ask for, Good RX and all these things, where they give you discounts on the drugs, right? That's because of him. He was pushing for that. So there's seniors can get their drugs now at a more affordable price, if not free. So all of that stuff stemmed from that in the 80s over there when all this heart-wrenching stuff was going on, and we were actually bringing it to light, seeing how seniors are living out their golden years, what was supposed to be their golden years anyway. So anyway, you want more information on reverse mortgages, you can go to reversemortgage.org. Okay, reversemortgage.org, it'll give you a lot more information about the reverse mortgages. Here you go, reversemortgage.org takes you to your guide to reverse mortgages. Gives all kinds of information and guidance about reverse mortgages. Okay. Now, I got a couple of links for that as well. So here is your reverse mortgage. reversemortgage.org. But here, I got a couple more videos on this, not from reversemortgage.org, but there's other companies that specialize, these lenders that specialize, and always you see their ads on TV all the time advertising. Now, this guy, you guys may recall him from the old Law and Order episodes. This guy was an actor. He also later became a senator. And then after he after being a senator, he became an actor. Actually, he was an actor, then became a senator while he was still an actor, I think, or he went back to it. And then he started doing these ads for AAG, which they're one of these major players in reverse mortgages.
It's not too good to be true.
Let me put that volume on there for you so you can hear better.
I mean, you get cash out of your home, no monthly payments, and still own your home. There's got to be a catch, right, Jesse? Well, there isn't. It's like any other mortgage, only with a reverse mortgage, the loan's paid back when the last borrower leaves the home. In fact, reverse mortgages are based on a notion that President Reagan signed into law over 25 years ago in order to help seniors remain in their homes. They're simply an effective way for folks just like you to get the cash you need to enjoy your retirement.
Call 1-800-791-4075 now to receive a new free information kit, including a reverse mortgage guide and DVD, personal stories from people like you, and a brand new family guide for children and loved ones, all absolutely free with no obligation. With a government-insured, tax-free reverse mortgage from AAG, you always retain complete ownership of your home. Call 1-800-791.
Hey, if you want to get this information from them, contact them, get that DVD set or whatever, however they send it now. And get the information, and then you could actually build this up, put this as a section on your website as available for people, even though we don't deal in mortgage lending, but you could have this as an option for seniors, how they could stay in their homes, their reverse mortgages, and then you can use some of the information they have, that educates you, and now you write your own version of it and put it on your website advising people about reverse mortgages, and you also learn in the process of it, So we're not about just selling people's homes and, helping them get rid of them when they're in danger of foreclosure, but maybe also guide them on how to keep their homes, We don't make any money off of that, of course, but hell, the content on your websites will help build additional traffic and real estate relation to it. So there's still a plus to it there for you. And plus, you can feel good about yourself helping those seniors out.
4075 to receive your free info kit today.
All right. And so there's a couple of commercials from this guy playing because they got a couple different explanations about reverse mortgages.
If you've been thinking about financial options for your retirement, maybe how to provide some real security for you and your family, you really ought to consider a reverse mortgage with AAG. In uncertain times, it's a safe, effective financial tool. It's already being used by hundreds of thousands of other Americans. It allows you to eliminate monthly mortgage payments, pay some bills, or simply enjoy your retirement more. A government-insured reverse mortgage with AAG allows seniors to stay in their home and turn their equity into tax-free cash. To qualify, there are no credit score requirements, and remember, you continue to retain complete ownership of your home.
The website for this is AAGreverse.com. Maybe add that link to these slides. AAGreverse.com, because they got a lot of information about it as well. I can get the edit screen here. Then. All right, so here, I'll give you that reverse mortgage links again. And those are the two links for that. I'm just editing a couple of these slides so that I could put those links in them. There we go.
Hi, I'm Fred Thompson. And you know, if you're like a lot of folks out there lately, then finances might be a little tight. Well, maybe it doesn't have to be that way. Because if you're 62 years or older and own your own home, then join hundreds of thousands of other Americans who have used a reverse mortgage as a safe, effective financial tool. A government-insured reverse mortgage allows seniors to stay in their own home and to turn their equity into tax-free cash without any monthly mortgage payments. You ought to call my friends at AAG. They could help you or your parents right now. And to find out more is absolutely free. Hi.
Okay, and then he died, so now they got a new guy up here. You probably know him. He was in Magnum PI and Blue Bloods and
I know what you're thinking.
another actor.
I thought what you thought. Some things are just too good to be true. Just like you, I thought that reverse mortgages had to have some kind of catch, just a way for the banks to get your house, right? Well, then I did some homework, and I found out it's not any of that. It's not another way for the bank to get your house, and it's also not too good to be true. A reverse mortgage loan is a simple idea, really. You turn your home's equity into cash, and you pay it back when you leave the house. Most people use the money to pay off their existing mortgage or pay some bills, cover medical costs, even update their home. And, just as importantly, you still own your home.
Now you see something on screen here. The borrower could be subject to foreclosure still, including reasons of failure to maintain the property, pay taxes, and insurance, right? Because remember, that property is still serving as collateral for the loan. But then again, that was still the same case before they ever applied for a reverse mortgage with their previous lender, where they're making payments to the lender. If they don't pay those important bills, they face foreclosure. So it's nothing different here.
And you make no monthly mortgage payments. It's a loan designed just for older Americans, and it's helped hundreds of thousands to live a more stable, secure retirement and stay in the home they love.
AAG is the leader in reverse mortgages. Call us today for your free information kit. It will answer all your questions and help you decide if a reverse mortgage is right for you and how to qualify.
I know what you're thinking. I did too. I felt the same way. But I checked it out, and I found out a lot more. It's pretty simple. A reverse mortgage from AAG can give you the retirement stability you're looking for. Maybe you want to check it out.
If you're 62 or older,
Yeah, but I don't think Tom Selleck needs a reverse mortgage. I think he's got enough money. He's got enough bank saved up from his acting career. All right, so let's continue here. Let's do these highlights about, then we'll discuss shared equity mortgages, package mortgages, blanket and wraparounds, and open mortgages. And so let's take all these notes and highlights, and then we'll go on to the next slides that will discuss them a little bit further.
Got it.
Okay.
Yeah, got it.
Okay.
I have it as well.
Let's go. Home equity loan does not pay off any current mortgage like the reverse mortgage would. It's a second loan. It's a second mortgage, a second loan on the property. Let me see, where's this? So the home equity mortgage is a second loan on the property. Equity is paid as a lump sum, as a line of credit. They give you a credit card and you spend that money as you like, as a line of credit. And then the borrower has to start paying it back right away, just like they do any other mortgage loan. A bridge loan is when you're buying a home before selling your current one. It's a form of short-term financing to make payments on both homes until the current one is sold. And the next slide will go over the details about a bridge loan. A shared equity mortgage is the purchaser needs financial assistance, and an investor lends them money to buy and becomes a silent co-owner. So yeah, most purchasers need financial assistance to buy a home. So I don't like that wording though. Let me see. The purchaser needs financing. Let's say that financing to buy a home. And and an investor lends them money and becomes a silent co-owner. Okay. The partner investor shares in the profits from the eventual sale. This option, okay, so let me give a little detail about this. A shared equity mortgage is, okay, silent co-owner. This option is used by religious people when it's against their religion to pay interest. They partner with an investor, which could be their religious organization or leader that lends them the money, interest-free, or another lender. So shared equity mortgage is one of these interest-free loans where you don't pay interest on the loan. However, the investor that lends you the money becomes a co-owner with you in the property, hoping that when you eventually sell the property, that they'll become, they'll get their money and profits then. Remember we spoke about that before? Remember? Maybe. Okay, so we got the home equity line of credit. We have a shared equity mortgage. I like this definition a little bit better, so I'm going to switch that in the notes that I am making for you. And then we got a package mortgage. A package mortgage is used to finance the purchase of real estate and chattel. What is chattel? It's tangible personal
property.
Right, so it could be used to buy a fully furnished condo, for example, or one that has appliances. It's fully furnished or comes with new appliances. So we buy maybe some new construction that comes with that. Useful for financing real estate with furnishings or appliances, which are personal property. Chattel or chattels. There we go. So yeah, you could buy like a new condo that comes with those furnishings or appliances or even a new house, but the loan is used to finance the purchase of the real estate and personal property. Or we should say tangible personal property, right? What's another way of saying tangible?
Touchable property, like
Yeah, but what's another
goods or something like that?
Yeah, but there's a specific word that I taught you guys already about another word that means tangible personal property. It's chattel. Tangible personal property is chattel, but what's another word for tangible? corporeal. Remember that?
Corporeal, yeah, sorry. Corporeal, yeah.
And incorporeal. See, I told you a lot of this is about vocabulary. You like these definitions? You may want to get a screenshot of them. You know, even though I'm highlighting the stuff in the book, these are a little bit more direct and easier to understand than what we're highlighting here in the book as far as notes go. Okay, can I change the slide, or is anybody snapping a picture over here? Taking
I'm
a
good.
All right, so bridge loan. Bridge loan, usually when somebody's selling one home and buying their next home, we try to do coinciding closings on these transactions so that they both close within the same month, so that they're not going to have to make a mortgage payment on two separate properties. Okay, that's probably the most ideal situation, but it's not always possible. Sometimes that seller or buyer needs to buy their next home before they complete the sale on their existing home. But they can't make the payment on both. So what they could do is they could apply for a short-term financing that'll help them make those payments so that they could swing the payment in the interim to bridge that gap between the time they buy the home and they sell their existing one. This is why they call it a bridge loan, swing loan, or interim financing. It's a short-term financing, usually not meant for more than 6 months, because you should be able to sell your house in 6 months. So it's used when the homeowner has to buy that new home before closing on the sale of their existing home. It allows them to bridge the gap so that they could swing the payment in the interim. There, I use that terminology in a way that we could understand it a little bit better for this argument. So it's used when the buyer can't afford making payments on two home loans and they got to purchase the next home before they close on the existing one. Let me add to that. And they need to close on the purchase of the new home before the sale of their listing home. Kind of already had that in there. This temporary financing will help. That's all right. It's a little repetitive, but it's whatever. It's good. So that's a bridge loan. Let me update that definition that I have here. Bridge loan. All right, sorry, I just duplicated my notes. I just realized, so I'm looking for that shared equity and just replacing them. The notes, package mortgage, shadow. Okay. Loan. All right, I got the notes in order. That's good. All right, let's continue. So a blanket mortgage is secured by more than one parcel. It's used to finance subdivision developments. It contains what's known as a partial release clause that would allow selling a smaller lot for the larger one without having to pay back the entire loan in one shot. Starting off a larger lot, a smaller lot off of a larger one, without having to repay the entire loan. It only requires repayment. It only requires paying back a portion of the loan as the lots are sold instead of having to pay back the entire loan at once. A partial release clause is sort of like a modified alienation clause, which is also known as the due on sale clause, which says anytime you transfer the ownership, you got to repay the entire loan. Remember, due on sale. The loan is due on sale. So it's a modified version of an alienation due on sale clause, which would require you normally to pay back the entire loan when you sell it off, when you sell property or transfer the ownership. So with the blanket mortgage that has that partial release clause, it would allow you to sell off smaller lots off of the larger one without being required to pay back the entire loan in one shot. Here's an example, a little screenshot. We have one lot, a blanket mortgage was used to purchase the whole property. Now they subdivide it into 6 smaller properties, and they built a house on one, and they're sold off one lot off of the. They wouldn't be required to pay back the entire loan for the entire property. They just pay back 1/6 of it. And as they sell off those smaller lots off the larger one, they pay back the loan in portions instead of all at once. Just to give you a little visual depiction of it, that's why I got that slide up for you. Okay. A rental mortgage is a type of seller financing. When the seller offers seller financing, a loan to the buyer to finance the purchase of their home, but yet they still have an existing home on their property that does not have an alienation clause in it. Because an alienation clause would require anytime you transfer the ownership to pay back the loan in full. Some loans don't have an alienation clause in them. They're assumable loans. So this would allow the seller to sell the property without first paying off that existing loan, as long as they continued making payments on it. So the new loan from the seller to the buyer does not disturb the underlying financing. It wraps around it. That's the concept of a wraparound mortgage. This would allow the seller to transfer the ownership without first paying off the existing loan. The new loan from the seller to the buyer does not disturb the underlying financing. It wraps around. That's why they call it wraparound financing. Game Zoom controls getting in my way. Sorry. Okay, so the seller offers the buyer financing at a higher rate than their current loan. The buyer makes the mortgage payments to the seller, and the seller continues paying their existing loan. So there's two loans on the property, and one does not disturb the other. They wrap around without ever touching it. So use a little note. It's a good idea for the buyer using such financing to put a contract in place that would allow them to communicate directly with the seller's lender in the event that they stop making the mortgage payments for whatever reason. The buyer could communicate with the lender directly to make the payment as a safeguard. Right? Because the lender is not going to talk to somebody who's not on the loan, that's not on the financing, right? So that's what that is talking about. Now, an open-ended mortgage is one that never actually closes. An open-ended mortgage would allow the owner or the person who has an open-ended mortgage, the borrower, to continue as they pay off the debt, to continue then borrowing more money off of the equity as they build it if they were to need it. However, this type of arrangement, the lender would have to agree to it. But they don't have to agree to it. Okay. So that's an open-ended mortgage. And then a construction loan. Most construction loans, construct is to construct to make new where there's nothing. So therefore, it would be type of first loan. A construction mortgage is a first loan and not a second. You know, those loans to fix up existing structures, those are rehabilitation loans. Sometimes they're referred to as construction loans, but because they're doing construction, right? But generally speaking, for exams anyway, when they ask about first and second loans, a construction loan is generally a first loan and not a second. It's to construct, to build a house, to make new where there isn't one already, right? They often carry high interest rates, and the lender pays the contractor off in stages as the work gets done, and then is verified in stages by an appraiser who confirms that when the work is done up to a certain point. And then they report back to the lender and releases the funds to pay for the materials and the labor up until that point. And then they start phase 2 of the construction. You see, for these types of loans, these construction loans, you got to use builders, the contractors that'll do the work and supply the materials up front, and then get paid in stages as the work gets done. That's why work gets done on houses, and then you see it seems like construction stops for a while, and then all of a sudden it picks up again. You guys ever see that? This is why. They're waiting for that lender to release the funds because phase 1 of the construction is done, and the reporting by the appraiser, the inspection by the appraiser, reporting back to the lender, and then waiting for the lender to release the funds to pay the contractor in stages is getting done. And then they could start phase 2 of the construction. That's how those loans work. Any questions?
Nope.
I'm good.
I just wanted to ask, there's a house around where I live that says coming soon? Like, would that be a
That's
type of a construction loan?
that, there's a house there already?
Yeah, there's a house there and they're like, I don't know if they're gutting it or whatever the case is, but it looks like they're taking things down from the inside.
Well, they may
But
be
it
doing
says,
and fixing and flipping the house or whatever it is. But all a coming soon listing is, when you see coming soon, all that is a showing. Okay, so basically you have a listing. You can't advertise a property as for sale unless you actually have a listing. So
yeah,
that agent already has the listing. It's just the owner signed a delayed showing request. They
got it.
could only delay it for a maximum of 10 days. If they need more time, then they'll need to sign a new coming soon or
Oh,
delayed.
because it's been like a couple months, maybe like 2-3 months I've seen the coming soon sign.
Well, they need to keep signing, filling out. That agent needs to keep getting new delayed showing forms signed by the owner, and the max to be delayed is 10 days, and then they could sign it. Then they got to get them to sign another 10-day delay, and another 10-day delay, and another 10-day.
Okay.
They shouldn't be putting out a for sale sign unless they have the listing already. So if it's been for months like that already, I can't foresee them getting a listing and then just putting up the sign and continually doing these delays. If they did, that's one thing that's allowed. But if they're just put up the sign early, that agent's violating the rules.
Mm. No, because it's been months, and I was like, I wonder what that means. Like, I know that it means it's a listing, but it's like coming soon when?
Have the agent find out. Ask them, this has been up there for months already. Do you actually have a listing or not? I know your agents can't be advertising properties unless they actually have a listing of the property for sale. Is this property already listed for sale and it's just a delayed showing? Or is this, or did you just put that sign up early? When is it coming for sale? Do you have an idea? Yeah, ask them.
Yeah.
Ask them.
I will.
You later on about, hey, you're interested in buying a property or anything? It was a while ago. I'm not interested no more. Take me off your list. All right. But that's all it is delayed showing. Okay, now we're going to talk about different seller buyer arrangements. Seller buyer arrangements. Yeah, sale leaseback. Yeah, let me change the title on here on this slide. Got to grab a different. It is another financing technique, but these are seller buyer arrangements. So a sale leaseback is what it sounds like. You're selling the property, the owner of the property sells the property, and then leases it back from the new owner. Why would they do that? Why would you sell your property just to lease it back from the new owner? Well, this is often done. It's often used for commercial purposes in commercial real estate. And this is often done when the business owner needs cash, whether it's to expand their business or maybe upgrade their machinery or software or whatever it is that they need to upgrade. But instead of going out and taking loans, you're actually occupying the property that has equity in it. So why not just drain that equity by selling the property? I mean, they could get equity loans, I guess, on their property, but instead, this is just another possibility. They could sell the property to get a much larger cash infusion, right? and then they just lease it back from the next owner. So does the owner that's selling the property have a lot of say in who they sell it to? Do they have a lot of leverage in the lease negotiation that they negotiate? What do you think? If you're the one that's selling the property, you got a lot of leverage on who you're going to sell it to and what the terms of the lease are that you're going to agree to. Otherwise, you just don't sell them the property. Where are you guys? Where are you guys? Disappearing on me, or what's going on? Hello?
Yeah.
I'm still thinking.
Well, I mean, you're the one that's the seller. You get to decide who you're going to sell it to. You're going to try to negotiate a lease with the next owner. You have a lot of leverage in who you're going to sell it to. You have a lot of leverage in negotiating the terms of the lease to be favorable for you. If you're the one that's selling the property, you don't have to sell it to somebody who does not want to negotiate with you on the terms that you want. So you have a lot of leverage in selling that property to somebody and negotiating the terms of the lease back, how long it's going to be, how many times it's going to be renewed, and the amount that the lease is going to be for, and all of that. You got a lot of say in that. But remember, this needs to be amicable amongst the parties. Otherwise, why would an investor buy it? So it has to, there has to be some juice worth to make it worth the squeeze for them as well. All right. So did you guys get the highlights here? This is a type of agreement.
Yeah, got it.
Where the buyer becomes the lessor and the original owner becomes the lessee. Or another way to word that is a type of agreement where the mortgagor becomes the lessee. The sale leaseback, right? You own the property, you're the mortgagor. You have a mortgage loan on a property, and then you're going to sell it and lease it back. So now you're going to become the lessee, the tenant. So a type of agreement where the mortgagor becomes the lessee. Okay. This would be done to free up cash for working capital, for business to expand or to upgrade the equipment, etc. All right, let's get into the next one. So we got seller financing. Typical seller financing works like this. The seller takes back the buyer's mortgage and the buyer makes monthly payments and receives the deed right away, just as if they received the financing from a bank to purchase. Now, a land contract is another type of seller financing. It's referred to as an installment sales contract. You're making payments in installments and then waiting for the deed. It's like a lease to own. The buyer doesn't get ownership until the full amount owed is paid, or some other amount. Here, let me clarify this a little bit. Buyer doesn't get ownership until the full amount owed or some other agreed upon amount is paid. That's when the seller will hand him the deed. Well, that's when the seller will sign over the deed and satisfaction of lien is recorded. Well, only if they paid it off. That's when the seller will sign over the deed and a satisfaction of lien is recorded, or gets another loan to pay off the balance. So the buyer has a financial interest in the property, even though they're not yet the owner. They do have a financial interest in the property. They call that equitable title. Because they've been making payments towards the equity, building up equity towards the ownership. But they're not the owner yet until they pay off that full amount owed. So if they stop making payments, it's easier to get them out than a tenant. Than an owner. They don't have to go through the process of foreclosure. But it's harder to get them out than a typical tenant because they're more than a tenant because they're purchasing the property, right? So they're more than a tenant, less than an owner at that point. Yes. If you have any specific questions about how these types of arrangements would work, talk to an attorney because each one is individual and they write it up custom depending on whatever agreement that both the seller and buyer can agree upon. So, lease option is one where a tenant is agreeing to lease the property and they're given an option to buy. Remember, option contracts must be prepared by attorneys. It is a unilateral contract. It's a one-sided agreement or promise. So it's a unilateral contract. Leasing with an option to buy. So basically, how do these work? The terms of the option to buy, do they just pay additional rent and then that additional rent gets applied towards the purchase, or is that just used to purchase the option to have an option to buy? Well, when you have a lease with an option to buy, you're agreeing upon how much in advance they're going to purchase the property for, what the purchase price is going to be, and when's the deadline that they have to make a decision to purchase by. So they have to exercise that, they could exercise their option to buy, but they don't have to buy. Okay, they have an option to. So lease with an option to buy. Let's put a little further definition. The seller, let me see, the lessee Oops. How this thing get me do that? Okay, so the contract is negotiated. The option contracts must be prepared by attorneys. It's a unilateral contract. The terms are agreed to in advance, like the purchase price and a deadline to exercise the option to purchase. That's a pretty good explanation. Oh, not good. The size is fine. 18. There we go. And then a lease purchase is you're also leasing the property, but this is a buyout agreement. The renter will purchase an agreed upon price with a predetermined deadline. With a lease option, they have an option to purchase the pre-agreed upon price by a predetermined deadline. Just change that definition. The option contract must be prepared by attorneys. It's a unilateral contract. The renter has an option to purchase at an agreed upon price by a predetermined deadline. There we go. Let's keep that wording the same there. Any questions? Guess not.
No, it's quite clear.
Okay. So, let's have it here. Contract is also a contract for deed or an installment contract. It's type of seller financing. We went over it in chapter 11. We have the seller financing and land contracts, lease options, and sale leaseback. I think my definitions on the previous slide were a little more direct. Let me see. The buyer tenants are having a binding contract to buy a property if they choose to do so. In the meantime, the seller is the owner and their landlord. Yeah, obvious. But I think my explanation was a little clearer. But you use whichever one you choose to study to understand them.
So can you explain one more time the lease option? Means that when the seller sell lease back, understand. Seller financing lend, understand. What about the lease options?
So once again, you're leasing the property with an option to buy. Attorneys can prepare.
Okay. So that is something like that. We are taking a card on the lease.
So
you're lease, and then after that we have option to purchase.
Yeah, you're renting. That's a separate contract from the option. The option to buy.
Okay.
So the option to buy, that's a separate contract altogether. But it is part of the agreement. You're leasing and you have an option to buy. Now, how that option is set up will need to be prepared by an attorney. So the details of that will be prepared by an attorney. But the purchaser has the renter has the option to purchase at a agreed upon purchase price in advance by a predetermined deadline. So they already agreed upon the price that they're going to purchase it at. Now, they don't have to purchase, they have an option to.
Okay.
Okay. All right. You guys got that, right?
Yeah.
Well, not much to get, really. All right. So here, the Truth in Lending Act. We're going to continue with the stuff that everybody hates. Okay, we're going to get past this. Okay, Truth in Lending Act, TILA, or Regulation Z. Okay, so the federal government regulates lending practices of mortgage lenders through the Truth in Lending Act, the Equal Credit Opportunity Act, and the Real Estate Settlement Procedures Act, RESPA. And they merged a lot of these documents together in what is now called the TILA-RESPA Integrated Disclosure Statement, or TRID for short. Don't shoot the messenger. This is something that the agency that President Obama created. They took some of HUD's forms, the Truth in Lending Act, the Equal Credit Opportunity Act, and the Real Estate Settlement Procedures Act, those forms and those laws, and they merged them together into what's called TRID, the TILA-RESPA Integrated Disclosure. Okay, those were previously, they previously had all these forms, and that was managed by HUD. But now the Consumer Financial Protection Bureau, they merged them all and they renamed it. It's called TRID, The Reason I Drink, or TILA-RESPA Integrated Disclosure. So the Truth in Lending Act is implemented by Regulation Z. You remember what that is? We've discussed that one early on. Regulation Z requires full disclosure when talking about financing in an ad. So Regulation Z requires the borrower to be fully informed of all the finance charges. The rules do not apply to home equity lines of credit, reverse mortgages, land loans secured by movable dwellings, and commercial properties and cash purchases. So, and then we also have the Your Home Loan Toolkit under TRID. The Your Home Loan Toolkit has to be given within 3 business days of the completed loan application. When is the loan application considered complete? When aliens are present. Remember that? The aliens. When the consumer provided all the information of aliens.
That is when a can you say that again? The aliens? That's when the application is filled out.
The next slide's coming up, but yeah, aliens is the acronym for knowing when the loan application is considered complete. That's when the consumer provided all the information to the lender under the acronym of aliens. You know, they provided the address of the property, the loan amount requested, the income of all the borrowers, the estimated value of the property, the names of all the borrowers, and their social security numbers. That's what that acronym stands for.
Got it.
Okay. So until that disclosure has been made, the lender cannot charge any fees except for a credit report. Everybody get these highlights?
Yes.
Yeah.
So continuing on the next page, 292. The application is considered complete when the prospective borrower provides the address of the property, the loan amount requested, income, estimated property value, name of the borrowers, and their social security numbers, or aliens. That's the acronym. And there must be at least 7 business days between the delivery of the loan estimate and the closing. You guys already have this highlighted though, right?
Yeah, it's already here. We earlier had it done.
We went over it early on and we skipped back here. We did those highlights.
Yeah.
So Regulation Z, the Truth in Lending Act implements the Regulation Z implements the Truth in Lending Act. It requires the lender to inform consumers of the true cost of obtaining credit. It allows the consumer to compare loan costs of various lenders and avoid the uninformed use of credit. It requires full disclosure and truth in advertising when talking about financing in an ad when certain triggering terms are used. It does not apply to business or commercial loans, cash purchases, HELOCs, reverse mortgages, land loans secured by movable dwellings. It applies to all kinds of financing to consumers, though, not just real estate, such as ads to finance buying real estate, a car, or a set of pots and pans on television. If they're talking about financing the purchase in any way, shape, or form, they need to follow the laws requiring offering credit to consumers. That would be the Truth in Lending Act, TILA. So, the APR is the true cost of borrowing money. It stands for annual percentage rate. It's the interest rate plus any one-time incidental costs associated with getting the loan that are factored in to the interest rate. The APR is always just a smidgen higher, just a little bit higher than the actual interest rate that's being advertised, the regular interest rate, because it also factors in those one-time incidental fees associated with getting the loan that are non-reoccurring. Okay. So creditors that must follow Regulation Z are anyone that extends credit more than 25 times a year or more than 5 times if it is real estate that is the security for that loan or issuance of credit. Okay, remember this slide? Here it is again. It's a great note to study. It's pretty comprehensive. So this one slide will show you everything that you need to know about Regulation Z for exams. Okay. So Regulation Z is the federal law that implements TILA, the Truth in Lending Act, that requires full disclosure when talking about financing in an ad, if certain triggering terms are used. Now, what are those triggering terms? Well, if you mention an interest rate, a payment amount, a down payment amount, or the terms, the number of payments, or the term, how many years of payments, those would trigger the full disclosure requirement. So full disclosure would requiring adding a qualifying statement. If you don't add that qualifying statement, you're indiscriminately promising financing to everyone. And the law requires that anyone offering credit must discriminate. They have to say to those who qualify or to a qualified buyer. Otherwise, anybody who sees your advertisement could think that they could get the financing when in fact they may not qualify for it. So you got to use one of these terms in the ad if you're going to be talking about financing in an ad, and any of these triggering terms are used. You have to say to those who qualify or to a qualified buyer, and disclose the APR, which is different from the interest rate, the down payment amount, and the term. It does not apply to business or commercial loans, cash transactions, reverse mortgages, land loans with removable dwellings. The penalties for violating an administrative order of Regulation Z is $10,000 per day the violation continues, plus attorney fees. Every day that ad is in the public domain, you will get that $10,000 fine. Not up to, it is a $10,000 fine for every day that ad is out there violating the law. And if you willfully violate the law, it's considered a misdemeanor, punishable by an additional $5,000 fine and up to 1 year in prison. It's kind of crazy, the prison sentences and the fines that you could get for these types of things. Yet we see things on the news all the time. Somebody gets assaulted or beat within inches of their lives, and the people get probation, or they'll be lucky if they get a year in prison. You know, mess with the money. There you go. That's where the jail time comes in. Okay, everybody got this?
So Victor, one practical question.
Yeah.
Is this regulation G TILA is applicable when the buyer is closing is called a closing statement or DL? There, this is all is applicable, correct?
We're talking about advertisements.
Oh, advertisements. Okay, understand.
Yeah.
Okay, so even if you remember, I think last week I asked you a question about the fine. So this thing, the first fine be the $5,000. So
no. If you violate this law and give full disclosure of all the financing terms, and you're talking about financing in the ad, it's not up to. It is a $10,000 fine for each day that is out there for the public to see. Each and every day, it's another $10,000.
Okay, got it.
Willfully violated the law knowing this, but you just didn't give a crap because, hey, let them do something and see if they catch me. Another $5,000 and up to a year in prison.
This is for the this fine can be applicable to the listing agent or the broker, correct? Who is advertising the property?
Yes. Yes. But and I told you, this does not apply only to real estate. This law
it's applicable to everyone, yeah.
Be offering credit to the consumer. You could be buying, you could see that lovely pots and pans for sale on a commercial on TV, and they start talking about how many payments you could get this for, you know, and how many payments. Yep, they're talking, well, number of payments, isn't that the term? Number of payments or years? Okay, you're talking about financing, full disclosure is required. Look, next time you guys see a commercial on TV about pots and pans for sale or car commercials, you'll see something there about Regulation Z or TILA. If you pay close attention, if you're able to pause it on TV, pause it and look at closely. The text may be the same color as the background, so you could barely make it out, but it's there. Okay. Or you have the speed talker talking on those commercials while they flash up some text on screen. Doesn't say how long it needs to be up there, just says it needs to be up there in the ad. All right. So Regulation Z has that 3-day right of rescission. You guys have these things already highlighted too as well, right? And these notes in there: purchase money mortgage, any loan, including seller financing to buy real estate. Anybody not have these notes? Need a time for me to keep it up on screen, or can I switch it?
No, we have this.
Okay,
Yeah, we have. Yeah, it's highlighted.
Okay, because all of this is just explaining, this is just highlighting the stuff that I explain on this slide. You see, from page 291 to 293, there's a bunch of stuff that you got to highlight and take notes to equal what you see on this one screen here before you. And it doesn't give it as clearly straight out. So my page there is probably a better note to study from. Yeah. Rescission, they talk about there's no right of rescission for purchase money mortgages. And Regulation Z applies to all credit advertising if any of the following triggering terms are used. And they explain here the amount or percentage of down payment, number of payments or payment periods, amount of any payment, and amount of any finance charge, the interest rate. And then here's the examples of that, what they would look like. 30-year loan available, payment of $1,432, including principal and interest, or only 5% down. Well, those are the things that would trigger full disclosure. These are terms that would not, if you put these in the ad instead of these. So here are the penalties, page 293. See, this is all the stuff that I had on that one slide where I made the note for you. Okay, ECOA, we did this in chapter 4, actually. ECOA, the Equal Credit Opportunity Act, was a law passed to prevent discriminating against women. I know now in the book and on the slide, it talks about all the protected classes because it has to, but the law was originally created to protect women because, you know, you tried to go in and get a loan to buy a house or buy a car, and they'd say, where's the husband? Where's the husband, Missy? Why don't you go and bring the husband back so the men can discuss the finances and we could get you into this a car or a house or whatever. You know, it's very degrading. So, but that's the way the times were, I guess. You know, so you know, it applies to lenders and others granting, arranging, or denying credit to consumers based on their credit scores, their reports. Originally created to protect women who were denied loans because of their sex, assuming they may not work outside the home. It prohibits discrimination on the basis of, now we're going to lay out all the protected classes, race, color, religion, national origin, sex, marital status, age, dependence on public assistance. Okay. Use tenant screening or grading reports instead, may be a good option. However, due to political changes in the law, use caution in whenever doing that. Remember that we got that Fair Chance in Housing Act now. So basically, if you're going to be renting to somebody, we often ran credit reports on people and did criminal background checks. So it's advised that you use tenant screening or grading reports. However, you're still responsible if those tenant or screening or grading services do not comply with the laws and how they grade the tenants based on if they're using criminal history to factor it in. Because, you know, if you look at somebody's criminal background and you use that against them, and, you know, the criminal justice system is inherently racist, or what's the word they use? Systemically racist, because there are more people of color in prison than there are white people. So therefore, if you use their criminal history against them, because there's not an equal number of people of color, white people in prison versus people of color, it is therefore systemically racist somehow. I mean, that's quite a leap to take, but that nonetheless, that's the leap that these politicians have been making ever since the Obama administration came out with that declaration. They waved their magic wand and said, well, because there's not an equal number of criminals in prison of color versus white criminals, if you rely on criminal background checks, that therefore by extension makes you racist. You know, that's the dumbest argument I've ever heard, but yet that's actually been going around for years now, and it has been laws being passed based on that stupid report that is very flawed, and it's using a hell of a leap. And, you know, I've had these conversations with people of all races in this class, asking them, if you have a home that you're putting up for rent, and would you want to do a credit check on those people first, an employment verification check? How about a criminal background check to feel safe that you're renting to someone you'd feel safe living in your house? You know, and most people agree, yeah, I would like to do that. Well, that would make you racist then. Doesn't matter your color, that makes you racist, you know? And they're scratching their heads wondering, how can that possibly happen? Well, I just told you the story of what led to that, and that's how it became about. They passed laws in New Jersey. They passed laws at the federal level that make this illegal. Because it makes it discriminatory. Because even though they say it does not make a criminal a protected class, it kind of does by what it requires. So, see the latest Attorney General's memorandum, specifically the part on the Fair Chance in Housing Act that we went over in Chapter 4, which basically makes ex-convicts, which they renamed system-involved people, a protected class. But anyway, ECOA, it was a law that was originally put in place to protect women. And anytime somebody's denied credit, they need to be provided with a reason why they were denied credit within a certain time frame. They'll mail it to you, a free copy of your credit report, or your ability to obtain a free copy of your credit report, and an explanation of why you were denied credit. That's what the requirement is. Okay? Do I actually have that written in here anywhere? Applies to consumers granted outside the home, prohibits discrimination based on that. Use tenant screening reports, whatever. No new change the law, making real estate licensee liable for discrimination of screening. Okay. I should actually add more information about ECOA on this slide instead of just jumping to that. So I will. I gotta make this text smaller so we can make more room. People denied credit must be given a copy of credit report and mention or using okay. That gives you a better explanation as to what the what this law actually does. Yay. Okay. So the Real Estate Settlement Procedures Act, RESPA. You guys have this highlighted? Was ensured that the buying seller of residential transactions involving new first mortgage loans have knowledge of all settlement costs. You need to know that line for exams. The RESPA settlement statement, formerly called the HUD-1, is replaced by the CD, the closing disclosure. It explains all the final actual settlement costs to the consumer and must be provided at least 3 days before the closing. You need to know all of that. And at the beginning of the transaction, an estimate of those costs is given, called an LE, formerly the GFE, the good faith estimate. LE stands for loan estimate, formerly called the GFE, the good faith estimate. Of those costs is given, called the LE, loan estimate. formally the GFE, the good faith estimate, to the consumer within 3 business days of completing the loan application. Aliens. That's an acronym to remember all the information needed for a loan application to be considered complete. In certain situations, a new loan estimate must be reissued and triggering an additional 3-day waiting period before the consumer can close. And there must be at least 7 business days between the time the LE is issued and the CD, the closing disclosure, is given, which contains all the actual closing costs and provided at least 3 days before the closing. All right. So that's the Real Estate Settlement Procedures Act, RESPA. All right. Everybody get that?
Yes.
So here's another breakdown of RESPA and the Real Estate Settlement Procedures Act. You may want to snap a pic of that. So the Real Estate Settlement Procedures Act, once again, that's a federal law to ensure the buyer and seller in residential real estate transactions involving new first mortgage loans, not refinancing. The parties in the transaction have to have knowledge of all the settlement costs down to every penny in the transaction, who is getting paid. Does not apply to, once again, cash transactions, commercial loans, mobile homes, reverse mortgages, or home equity lines of credit. It is illegal for anyone to get paid in a real estate transaction if it's not disclosed on the RESPA settlement statement, the CD, closing disclosure, formerly called the HUD-1. Now, the LE is the loan estimate. It's an estimate of the loan costs at the beginning of the transaction. When you're just applying for the loan, the lender needs to give you, within 3 days of your completed loan application, a loan estimate. It replaces the old document called the good faith estimate. It must be given within the 3 business days of the completed loan application. And there has to be at least 7 days between the time the loan estimate is issued and the closing occurs. Certain changes sometimes may require reissuing of the loan estimate, which would trigger an additional 3-day waiting period. And then on page 299, we're going to get to it when we're going to show the situations that would trigger reissuing the loan estimate and an additional 3-day waiting period. Now, the CD, the closing disclosure, is accounting for all the actual settlement costs at the end of the transaction, at the actual closing, what the actual costs are going to be. This must be provided at least 3 days before the closing to the consumer so that they have a chance to review it. And the CD replaces the HUD-1 RESPA settlement statement. So buyers should compare the LE and the final CD, and if the costs vary beyond certain limits as defined by TRID, the lender is responsible for covering those costs. Ooh. Ooh, ooh, ooh. All right, you know what we're gonna do right now? We'll leave off right here. We're gonna take our lunch now. Let me pause this. RESPA, once again, is the Real Estate Settlement Procedures Act. We already went over this one, right? Yeah, we went over this slide. Okay, so that's that slide. Next up, TILA. The TILA RESPA Integrated Disclosure Statement called TRID, aka the Losing Cotton String. Hold on a second. Mute everybody. Get the background noise. There you go. So, TRID is the.
I don't think we can see the slide. I actually have the YouTube.
Oh, sorry.
Okay.
Yeah. TRID, TILA RESPA Integrated Disclosure. That's the CFP. You can see it now, right?
Yeah.
Yeah.
Previously went over, we did this one, and then we got this. Okay, so the TILA RESPA Integrated Disclosure, that's the CFPB merged and modified the existing HUD forms and created this one. Lenders are responsible for delivery of the documents within certain time frames, and lenders are liable if certain costs exceed the tolerance limitations imposed by TRID. You should compare the estimated cost on the LE versus the actual cost on the CD, the closing disclosure. So the LE is given at the beginning of the transaction when somebody first applies for the loan, and they give an estimate of what those loan costs are going to be. And at the end of the transaction, you find out what the actual costs are going to be. You should compare those two documents. They should be fairly close. They could be off by a little bit, but there are certain limitations that the actual cost cannot be above there are certain tolerances that they're allowed to be off by. And if they're off by too much, then the lender needs to eat those costs. So the TRID rules do not apply to, once again, HELOCs, reverse mortgages secured by movable dwellings, reverse mortgages, cash transactions, or loans for commercial properties. So all we're doing is on page 294, just highlight that it does not apply to those and highlight that straight down. Lenders are only allowed to charge fees to the consumer other than a credit check. They're only allowed to, for running their credit, they're only allowed to charge other fees such as loan application fees and appraisal fees and such after the consumer indicates an intent to proceed. And this is done by submitting a completed loan application or all the information required of aliens. Address of the property, the loan amount requested, their income, estimated property value, the names, and their social security numbers. When all that information's been provided, now they can start charging application fees, appraisal fees, and any other kinds of fees they may have. You guys got that?
Yes.
What page is that on? That's on page
294.
294, okay. I just didn't see a page number on there, so. All right, so estimate, also on page 294, the LE. We're just gonna highlight down there at the bottom of the page and we're gonna write replaces the GFE, the good faith estimates. And we're gonna underline, we're gonna do this highlight. And you can write there along with the toolkit because they got to send that home buyer's guide toolkit or the home loan toolkit within 3 business days of the completed loan application as well. Your home loan toolkit. So the loan estimate has to be provided within 3 business days of the completed loan application, aliens, and at least 7 days between the time the loan, the LE is issued and the closing actually occurs. Now you may be thinking, well, there's a lot more time to that when the beginning of the transaction is when they do the loan estimate stuff. There's going to be 2 months between that time usually. Well, yeah, but there are certain instances where a new LE has to be reissued. So a few circumstances would trigger that reissuance of a new loan estimate. And there has to be at least 7 days between the time the loan estimate is issued and the time the closing occurs. And if a new LE needs to be reissued, that also requires an additional 3-day waiting period as well. Now we're going to be learning about what requires that reissuance of a loan estimate in a minute. You guys got this?
Yes.
Okay. So now the next page, you could see the TILA RESPA integrated disclosure statement, the several pages that it is, and then go to the 5-page document. Then we're going to go to page 299. And page 299, we could see these are the things that would trigger a new loan estimate, and these are the changes that would not. Let's just highlight those and then put the little bracket around these sections to what do you call it? To separate them, to segregate them. Oh my gosh, my brain, I'm getting tongue-tied. Compartmentalize. There we go. That's it. The oh my God, I can't even say it. To put them in their own compartments. To compartmentalize. Oh gosh. So tongue is not working properly today. You guys get what I say. Put that bracket there and highlight that. Compartmentalize. Oh my gosh, can't even say it right. What's going on with me today? All right. So now let's go over those issues. I would just retype them on this slide. So the situation that would trigger an additional 3-day waiting period and the reissuance of a new loan estimate is the consumer requests a change in the loan or the amount of the down payment, or the appraisal came in higher or lower than expected. Oh, we know that never happens. Or there's changes in the borrower's credit score or debt. Listen, this is a tip for you. I put a yellow highlighter here. It's important. When you're working with buyers, when you start working with them, you should coach them at the beginning of the transaction. Do not make any large purchases, charges, layaways, car leases or purchases, or changes in unemployment until after the closing, because it will change the possibility of you being able to even get the loan, especially if you're changing employment to something totally different than what you were doing before. So lenders could not document the borrower's pay, like overtime, bonuses, tips, and other income. This would trigger the requiring of a reissuance of the loan estimate. And that's quite common for people who are relying on bonuses, tips, and other income. Bartenders, people who work in salons, waiters, waitresses, strippers, there's all kinds of jobs where people rely on bonuses and tips and things of that nature. Costs change for the services the borrower cannot shop for. The interest rate changed because the borrower did not rate lock or it had expired. The consumer could purchase an extension on that rate lock. The prepayment penalty was added. I know no prepayment penalties allowed in New Jersey, but that's for institutional lenders. It still does apply for other private loans and commercial loans. The loan product was changed, or the APR increased beyond allowable limits, 1/8 of a point for fixed rate loans and 1/4% for adjustable rate mortgages. All these things would trigger the reissuance of a new loan estimate and an additional 3-day waiting period. So, and remember, there has to be at least 7 days between the time the LE is issued and the closing occurs. So here are the timelines of these documents. Well, first of all, aliens. That's when a loan application is considered complete, when all the information of aliens have been provided to the lender. An LE, the loan estimate, that replaces the GFE, the good faith estimate. You have to know that. And it must be given to the consumer within 3 business days of their completed loan application. Aliens. And there must be at least 7 days between the closing and the time the LE is issued. A new loan estimate may be issued under those certain circumstances we saw on the previous slide there, that would trigger an additional 3-day waiting period. The Your Home Loan Toolkit has to also be given to the consumer or placed in the mail within 3 business days of their completed loan application. And then the CD, the closing disclosure, is the new document that replaces the HUD-1 RESPA settlement statement. So the lender has to provide that at least 3 business days before the actual closing, so that the consumer has time to review it. Okay, so on page 299, what is a business day? We keep talking about within so many business days, they need to provide this and that. So what's a business day? Oh, there's 2 definitions that exist for a business day. One definition of a business day is any day that the lender's open for business. And the other definition is any calendar day except Sundays and federal legal holidays. So depending on the lender, the creditor, Saturdays might or might not be considered. There you go, clear as mud. So let's write this LE above where it says loan estimate, because that's just a abbreviation for loan estimate. And right there that it replaces the GFE, the good faith estimate, and then highlight this, so the timeline that it needs to be given in, and do the same thing for the CD down here. And then also write when the consumer signs the loan, and that's at closing. So like that. And let me know when you guys have those notes.
Hello.
Yes.
So I have one quick question.
Yes.
So this CD, final closing document.
Yep.
Why sometime differ? Same property, if 2 person is purchasing, CD is different for me, CD different for my friend. So the detail of the amount, that this amount, that amount, is not much different.
Hold on, I can't answer your question if I don't understand what you're talking about. What do you mean that your CD is different than your friend's?
Okay, so the same builders, they have the new builder, and they build a multiple single family home, same size home. Me and my friend both purchased.
What about the price?
Price are the same.
What about the, are they providing the financing?
Yes.
Are you getting it at the same interest rates and everything?
Same interest, everything same.
Okay.
Price was same, down payment are same, and the interest rate is same. But when the final closing CD came, and you see the CD has different details of all the numbers. But the difference of around $3,000 has the difference on the closing cost.
And what did the CD say? What numbers were different? You got
few of the items has different. I can send you the both CD and you can see why this is 2 different. But it's prepared by 2 different dates.
It doesn't matter, like document prep fees and things of that nature. If they're 2 different lenders, they could charge different fees, but with the same one, it should be the same fee.
I think on the beginning, lender was also the same, but after that, they sell our loan to 2 different people, 2 different agencies.
Was there an application fee or some other fee that was different? You got to compare the fees that they're charging there. certain fees the lender could charge. Like one may charge you an application fee, the other one may not. And how much they charge. Well, that could be flexible depending on the mortgage rep. Some fees are basically BS fees that they don't need to charge at all. They're just fees for the lender or the mortgage rep to make money on. That's why if you look at the CFPB's Your Home Loan Toolkit, you could examine the fees and see which ones are BS, and which ones are optional, which ones are mandatory, and then, they're optional for the lender to charge. They're not optional for you to pay. If the lender's charging them, well, that's their fee, So you got to see which ones are optional for the lender to charge and which ones they have to charge. By looking up that Your Home Loan Toolkit, it give you a little guidance on those fees and such. But then you can
because my closing happened after 15 days of his closing, my friend closing, and I think I have paid $562 extra.
And you guys were still at the same lender and same interest rates?
Interest rate is same. Interest rate was same, but the lender is same or not, that I'm not sure.
What about the down payment and closing cost? What about the down payment?
Down payment, we submitted same down payment.
You guys made the same exact down payment?
Same exact down payment, yes. Because that was because in the beginning they were saying that we have to buy a 3-point, and they said that if you guys are increasing the down payment to 25%, then the interest rate is also down, and the point is also in place for 3-point. They bring as a 1 point only. So we made the same down payment, 25%.
What about the taxes and the monthly maintenance fee?
Yeah, I think maybe after 15 days, they made something change on that there, and then I had paid $562 extra. I said, okay, let's forget this. Too much things to compare.
And the homeowner's insurance. So if you guys are including those fees in your monthly mortgage or not, did you both include them in the mortgage?
The insurance is on the monthly mortgage. You are included.
Well, the thing is, if one of you included those fees in your mortgage, which you're not required to, and the other one didn't, that could be a difference. Or how much you pay in those fees, your taxes, your homeowner's insurance, and the monthly maintenance charge could be different, and so what makes up your closing costs are those impounds for the coming year's expenses. So you could check on that too. I'm just giving you some ideas where you could check. I'm not defending anybody here. I'm just trying to come up with a rationalization of why that would be. Then again, you could also contact.
Yeah, so that's what I'm thinking. Yeah, these things can be different, and there can be few dollars some here and there can be happen.
Yeah, but $3,000 is a lot. So I would ask the builder. I'd ask that lender, whoever prepared it, actually, why the cost.
No, finally I paid only $562 extra, because on the beginning when we say $3,000 difference, I said how this is possible.
So the difference ended up only being smaller, ended up being like $500.
Yeah, they bring down to the $562 difference.
All right. Yeah, you really got to examine those documents to see the difference.
Okay. Yeah.
Everybody get these notes? Hello?
Yes.
Okay. All right, so I told you guys that you guys should advise your clients not to change your jobs, do any large purchases or anything like that. Now, some of these things, they are so common that here's a video of a real estate agent made because this is such a common thing that it's kind of a joke, because you could advise your clients on it. It's a thing I'm trying to hammer into you to remember to advise your clients right now. But once you advise your clients on it, if you don't make it stick and let them know how detrimental this can be to their transaction, they're going to do crap like this anyway. Anyway, so here's a little video that this agent made about frustrating things in the real estate business that you're going to come across and that's going to happen to you. stop it periodically and I'll point out some things that may require a little bit of an explanation, but it's a little goof video that this real estate agent made. I think she's from Canada, and so that's why she's talking in French to somebody on the phone for a second there, or in her greetings. Yeah, let's take a look and watch. It's a pretty clever little video that she made.
Gemma, I've really been thinking about getting into real estate.
Right?
It seems like you've got such a flexible day. You
Yes.
can drive around all the time and make your own schedule.
Right.
It seems like fun and easy.
Gemma Leggett, bonjour. Tomorrow morning as on Christmas Day?
She wanted to see 10 houses tomorrow morning. And she's like, tomorrow morning as in Christmas Day? Yeah, people will have no respect for the value of your time. You need to be able to set time limits where you're going to not pick up your phone. Or maybe even have a second phone number that you use that rings in on your same phone. You don't need to get a separate phone per se. You could have a different phone number that then forwards to your phone, as a business line that you could turn off on certain times where it just goes to voicemail.
Okay, I gotta pull up this address.
Oh, that's so frustrating. Sometimes when we're showing homes, we're pulling up the address so that we could go meet our clients or take them to a place. And the address isn't in any mapping system, Google Maps or any of those other Bing or any of those mapping systems. The address does not exist because they never updated their maps yet. And it could be a new complex or one that was been there for several years and it's still not in the mapping systems yet. That could be very frustrating. How the hell do you get to a property that's not even in the maps?
Come on.
These are the the push button combination locks. There's also the combo ones, and we most often use the digital lock boxes. But these ones, on certain properties, you have to use these, like on bank-owned properties and HUD properties. They have to use a HUD key or push button box like this. I tell you what, in the wintertime, it looks like they're there in the winter. You get a little water in there, it crystallizes, turns to ice. It is a son of a gun to try to get these things open, and you really need like to bang on it or get a hammer or something. And that's what she's getting at here. This is just frustrating.
I mean, you get to look at all these amazing houses and everybody's staging right now, right?
Yeah, most of them do. And this is the master bed. I'm sorry, we're not going to see this.
I mean, you get to...
That's happened to me on more than one occasion. You're showing a property and you walk in on people fooling around and somehow they didn't hear you when you're yelling real close as you're walking through the house. That's why I yell it like that. You don't just open up that key box even if you have an appointment to go. Somebody may have forgotten.
Work with people, and I love people. I'm a people person.
Gemma, we have some exciting news. We're pregnant.
So we have to stop looking at 2-bedroom houses and we have to start looking at 4.
But we have the same budget though still.
All your clients have to do is love the house and then they buy it.
Gemma, this house is perfect.
Right?
Yes, totally. But I feel like there's a but.
But we've only seen 87. I think that we should see some more. It needs to be perfect.
Yeah. This ain't HGTV where we're showing 3 houses and then those somebody's going to be picking from those 3 houses that you're showing them. You get people that want to see every single freaking house that's on the market.
So we did it. We found you the perfect house. This house is at market value. Okay, so they're asking $648,000.
So let's offer them $400,000.
Yeah.
Okay guys, we have received the home inspection report. So everything is good. We can now remove our conditions.
You said if we find something wrong, we could walk away or negotiate with them, right?
Right. What is wrong?
Well, The lights were too bright.
The paint? Mm-mm.
I didn't like the doorknobs.
It's just the atmosphere.
And the windows were kind of dirty.
It just
Then why are you making an offer on the house? Really? I mean, some of these things are very cosmetic issues too that you've seen when you were going through the house. Cosmetic is not a reason. Cosmetic problems are not reasons for renegotiating or canceling a contract. And that seems like, they say that it's not working for them. Well, then why did you even make an offer? Well, I know it's a goof video, but sometimes you get people that do stupid stuff.
it's really messing with my feng shui.
I get to see your social media account and all of those happy people. I want to make everybody happy.
Guys, picture! Hey guys, we're happy we just bought a house! Take a picture! Yay, cheers! Cheers!
Okay, so that's fine, but that's not a thing.
What
No, thank you.
You'll see, it'll be great.
No, thank you.
I mean, it's an easy job, and you get paid so well.
Okay guys, so the process is done. So from now on until closing, make sure that you're not buying any big purchases on credit.
Obviously.
Okay, so no boat, no vacation, no cars.
Come on, Gemma, we're not dumb. Gemma, what do you think of our new car?
Isn't it great?
You paid cash, right?
We got a wicked 1.5% rate.
It's going to throw up your debt to income ratio. Now you're not going to be able to afford to buy this house. You may not be able to qualify for the loan anymore. And usually the lenders don't just run your credit at the beginning of the transaction to give you that pre-qualification, then pre-approval letter, and then the loan commitment. You know, there's a big asterisk next to that, provided that your work doesn't change, your pay doesn't change, your credit, your debt doesn't change. And here you go. You people buy a car. That's why she said, did you buy it cash? Because it's definitely going to throw off your debt to income ratio of what you can afford to buy of a house. Geez, where was that? Let me try to get to that point again.
What do you think of our new car?
Isn't it great?
You paid cash, right?
We got a wicked 1.5% rate.
Yes. You know what? Honestly, I think you're going to love it. Would you like me to get you my books?
Sure, yeah.
Yes, do that.
Wait, you have to study all this just to sell houses?
Yeah, it's so easy. I'm a people person. Every job got its quirks and issues and drama. Yeah, real estate's no different. And that's it. That's it for this chapter. Chapter 15 is concluded. Let's do the key terms to review, and let's get started in chapter 16 and try to get that done in 2.5 hours, a little bit more than 2.5 hours. So let's get started here. Key terms to review number 1. Mortgage covering more than one parcel of real estate. A mortgage that covers more than one parcel of real estate.
Hold on. Mortgage covering.
It's a blanket mortgage. One is a blanket mortgage.
Blanket, okay.
Yeah. So, because it covers more than one, you could sell a smaller lot off of a larger one, right? So one is A. A mortgage covering both real and personal property. The purchase of real and personal property.
Package mortgage?
It's a package deal. 13 is B. Cooperative organization for members who save and borrow.
Credit union?
It is a credit union through a C. A privately owned corporation that sets standards and buys mortgages.
Fannie Mae?
Fannie Mae. 4 is D. Federal Home Loan Mortgage Corporation. This is package of mortgages originated by member savings and loan associations. FHLMC is the symbol there?
HLFMC. This is the
Federal Home Loan Mortgage Corporation. That's what it used to be called.
see.
Fannie Mae.
No. Oh wait,
This is Freddie Mae.
Freddie Mac, rather. I'm sorry, Freddie Mac.
Freddie
Freddie Mac.
Yeah, it's Freddie Mac. 5 is E, as in Edward. So the Government National Mortgage Association, that's what it used to be called, pools mortgages for investors. They're those riskier loans.
That is the Ginnie Mae.
Ginnie Mae, 6 is F. Additional financing for homeowner, usually a type of second mortgage.
Second mortgage is
Open-ended.
construction loan.
Home equity.
Home equity loan, 7 is G. Loans with interest only, typically for less than 6 months. What do we call interest-only loans?
Open-end mortgage? Oh, wait, no.
If you go by several different names, remember, let's just say that we're buying a new home before we close on the sale of our existing one. We get this type of loan that will allow us to make both the mortgage payments in the
Interim financing?
interim. 8 is H, correct. A loan higher than those usually bought by the secondary market.
Jumbo loan?
They're jumbo in size. 9 is I. Agent who makes real estate loans, usually for one lender. You should probably write that at the end of the line there in J. Agent who makes real estate loans, right there at the end of the line, usually for one lender.
Mortgage broker?
For one lender, it would be a mortgage.
Oh, got it. Okay.
Because they only work for that one bank. So they generally only originate loans for that bank, usually.
So usually for one lender, right? For one.
Yeah, so 10 is J. So at the end of that line, you're going to write usually for one lender.
10 is J. Okay.
Agent who brings together lender and borrower for a fee, and they can work with many lenders.
Mortgage broker.
A mortgage broker, 11 is K. A mortgage that provides possibility for further borrowing.
Open-end mortgage?
Yes, open-end mortgage, 12 is L. And a straight loan for short building period.
Construction loan.
That's the construction loan. 2 is M. All right, key terms 2. Before we get started, next to letter C, after the end of the line, write any loan to buy real estate.
Any loan to buy real estate.
Correct.
Yeah.
All right, that's it. And let's get started. Lending institutions that make mortgage loans to the public.
Lending institutions.
Lending institutions that make mortgage loans to the public for the purchase of real estate. Yeah, you can write that, to buy real estate, right at the end of that line, to buy real estate.
Primary mortgage market?
I'm sorry, primary mortgage market, you said?
Yeah.
Yes, 2 is A. Loan not intended for resale on a secondary market. What kind of loan is not intended to be resold?
Portfolio loan?
Yeah, portfolio loan. 1 is B. Seller financing. Any loan to buy real estate, not just seller financing, but any loan to buy real estate.
Purchase money mortgage?
Yes, 3 is C. An arrangement by which seller becomes a tenant.
Seller become tenant. The sale lease back.
Yes, 7 is D, sale leaseback. Process of deciding whether to make specific loans. What do you call that process?
Loan estimate?
No.
The process of deciding whether the bank or the lender is going to give the loan or not. They're
Underwriting?
analyzing the risk. What do we call this process?
Underwriting?
It's underwriting.
Underwriting, yeah.
11 is E. The words in an ad that require full disclosure of financing conditions.
Regulation Z.
The words in the ad.
Oh, triggering terms?
The triggering terms. 9 is F.
I got confused.
Yeah, it's pertaining to Regulation Z, but what do we call the words in the ad? That's why I like doing these key terms to review. It gets you to try to pay a little closer attention and focus more on how they word these things. So 9 was F. A percentage of income may spend on housing expense.
Qualifying ratio?
Qualifying ratio. 4 is G. A mortgage in which a lender sends regular checks building up debt. The lender sends checks building up debt.
Reverse mortgage.
The reverse mortgage, because that's the reverse of what usually happens, right? The borrower usually sending in checks to pay down the debt. 6 is H. A loan in which an investor shares payments and profits.
Loan estimate?
A loan in which an investor shares the payment and profits.
Shared equity mortgage?
A shared equity mortgage. 8 is I. Implements the Truth in Lending Act. TILA.
Regulation
Regulation G.
5 is J. Regulation Z. 5 is J. Regulates consumer loans. What regulates consumer loans?
Truth in Lending Act.
The Truth in Lending Act. 10 is K. Loan your loan that does not disturb the underlying mortgage or the underlying financing.
A wraparound mortgage.
A wraparound. 12 is L. Merges the TILA RESPA disclosures.
Trade.
Trade. Very good. 14 is M. Detailed loan costs.
Loan estimate.
Yeah, that's in the loan estimate. 15 is N. Required items before the lender can proceed.
Remaining is aliens.
Aliens. They need to make sure they submitted a complete loan package. All right. That concludes chapter 15.